You are sitting across from a loan officer. The number they give you isn't the price of the house, it's the monthly payment. And that number fits. And in that moment, the approval, the relief, the quiet feeling of having been evaluated and found credible, something else happens too. You accept a designation. Creditworthy. That's the word. No one mentions that creditworthy is a classification invented by institutions that profit when you borrow. You take the loan. You make the payments every month because you understand what responsibility looks like. Your credit score goes up. The system confirms it. You are doing this correctly. You are a model borrower, certified. At no point in this sequence did anyone ask whether you wanted to be a borrower in the first place. At no point was a version of adulthood without debt presented as an option on the table. The system assumed you would participate. It built the room before you walked in. You just sat down. That assumption has a traceable origin. I want to follow it. The belief that most financially literate people hold about debt isn't that debt is good. The belief is more precise than that. The belief is that debt, handled correctly, is a tool, a lever that, in the hands of a disciplined person, can accelerate outcomes that cash alone would take decades to reach. The operational form of this belief is a taxonomy. Good debt versus bad debt. Good debt builds equity, raises earning potential, or generates returns above its cost. Bad debt is consumer spending financed lifestyle, revolving balances, depreciating assets on borrowed money. The goal, as the framework presents it, is to use debt strategically, to be in good debt, managed well, and never in bad debt at all. Most people in the target income range of this series don't think of themselves as carrying bad debt. They have a mortgage, yes, but they chose a conservative amount. They financed a vehicle, but at a rate where keeping cash liquid was the smarter call. They have a home equity line, but only for a capital improvement that added value. They've internalized the taxonomy and made individually rational decisions inside it. They've done this correctly. And there's one more layer that structures all of this, the credit score. The FICO scoring system governs financial access for roughly 240 million Americans. It rewards active debt management, multiple credit accounts in good standing, a long credit history, consistent on-time payments across multiple instruments. It does not reward the absence of debt. A person with no debt, no credit accounts, and $500,000 in savings is effectively invisible to this system. The industry's term for people with insufficient credit history is thin file. The absence of debt is a deficiency. The score was built to measure participation in the debt system, and it has become the primary metric by which financial responsibility is graded in this country. That framework contains logic. That's what makes the next thing worth sitting with. Here is the one question that doesn't get asked directly. If responsible debt management is the goal, if the system rewards you for handling debt well, who wrote the definition of responsible? Who decided the correct destination for a financially disciplined adult was proficiency in debt rather than freedom from it? The FICO scoring model was introduced in 1989. It was created by Fair Isaac Corporation, a private company, and adopted by lenders because it gave them a consistent, scalable way to assess repayment probability. What it measures is not financial health. It measures creditworthiness, the likelihood that you will continue making payments on borrowed money. Those are different projects. A person who never borrows is not financially healthy by this metric. They are unscorable. The system that grades your financial behavior was designed by and for the institutions that profit when you borrow. That is not a structural criticism. It is a description of what the product was built to do. A creditworthiness score serves creditors. That's its function. The question is how a score built for creditors became the general purpose report card for financial maturity. Because that scoring system now follows you into contexts that have nothing to do with lending. Landlords run it. Employers run it in many states. Insurance carriers use it for pricing in others. A score designed to assess your value as a borrower has been accepted as a broader measure of how responsibly you're managing your life. The substitution was not announced. It happened gradually, by adoption, and the entity whose product created the score had every incentive to encourage that adoption. The question underneath this isn't whether you should pay your debts. You should. The question is who decided that having debt, managing it, maintaining it, never reaching a state of debt was the target in the first place, and whether that goal was constructed with your interests or theirs in mind. The mechanism is debt normalization. It has a specific, traceable origin. In the 1920s and through the Depression decade, personal debt carried a social cost. The generation that lived through the Depression treated debt as something to be discharged as fast as possible. The cultural assumption was thrift save first, spend second. Installment plans existed, but those were associated with limited means or insufficient discipline. Carrying consumer debt was not a sign of financial sophistication. It was evidence that you hadn't accumulated enough before buying. That changed. Over approximately 60 years, through a sequence of specific, financially motivated decisions by specific institutions. The first mechanism was the post-World War II mortgage expansion. The GI Bill and the Federal Housing Administration dramatically expanded access to mortgage credit for returning veterans. Home ownership was reframed as the proof of economic arrival, the visible structural confirmation of the American dream. What the mortgage expansion also accomplished was normalizing multi-decade debt as a standard feature of adult financial life. For the first time in American history, the median household was expected to carry a 30-year obligation, and critically, that obligation was not experienced as debt. It was experienced as homeownership. The financial commitment was invisible inside the cultural aspiration. The second mechanism was credit card design. Diners Club launched in 1950. Bank Americard, later Visa, launched in 1958. By the mid-1960s, the credit card had crossed from a business expense management tool into a mass consumer product. The design decision that matters is not the product itself, it's the minimum payment. Unlike an installment loan which has a fixed repayment schedule and a defined end date, the credit card has only a floor. You must pay a minimum. You may carry a balance indefinitely. The default behavior the product creates is not repayment. It's prolonged balance, revolving. That is not a side effect of the design. It is the revenue model. The third mechanism was regulatory. In 1978, the U.S. Supreme Court ruled unanimously in Marquette National Bank v. First of Omaha Service Corporation that a nationally chartered bank could charge its customers the interest rate permitted by the bank's home state, regardless of where the customer lived. Minnesota capped credit card interest at 12%. Nebraska permitted 18%. First National Bank of Omaha marketed cards to Minnesota residents at Nebraska rates. Minnesota sued. The Supreme Court ruled for the bank. In its closing paragraph, the majority acknowledged that the ruling would impair states' ability to enforce usury laws and said that was a matter for Congress to address. Congress did not address it. South Dakota and Delaware immediately repealed their interest rate caps and positioned themselves as bank-friendly headquarters. Citibank relocated its credit card operations to South Dakota in 1981. Other major issuers followed. The states that had protected consumers from high-rate lending lost the legal mechanism to do so. In 1978, the year of the ruling, total revolving consumer debt in the United States stood at $48 billion. By 1985, it was $131 billion. By 2008, it exceeded $992 billion. That is a 20-fold increase in 3 decades. Credit cards, which had previously been operated by banks as break-even products designed to attract depositors, became their highest margin business. The customer the industry most valued was not the one who paid in full every month, the transactor in industry language, who generates interchange but no interest. The most valuable customer was the revolver, the person who carried a balance month to month, paid the minimum, and generated compounding interest on the outstanding amount. The design of the product, its pricing structure, and eventually its marketing, all optimized for that customer. Now combine those 3 mechanisms: mortgage normalization, revolving credit product design, and interest rate deregulation, and you have the conditions for a fourth: the cultural recategorization of debt itself. That recategorization required a language. The language arrived as financial literacy. Good debt versus bad debt. Leverage as strategic choice. Debt management as a distinguishing skill that separates financially sophisticated adults from the undisciplined. These framings weren't produced by independent academic research and distributed neutrally. They were adopted by financial media, financial advisors, and eventually personal finance education, much of it produced with materials funded or provided by financial institutions. The framing spread because it served the interests of the people circulating it. By the 1990s, the question in any conversation about money had shifted. It was no longer, do you have debt? Are you managing it correctly? The conversation moved from whether debt was the right state to be in to how well you were performing within it. The system itself was no longer the subject. Individual competence inside the system was. The FICO score operationalized this shift, a numerical metric developed by a private company, adopted universally by lenders and insurance carriers, made active debt participation the entry condition for full financial access. Want a mortgage? Score. Competitive car loan rate? Score. Apartment lease without a massive deposit? Score. The score is a function of debt behavior. No debt history means no score. No score means restriction and exclusion. No announcement was made that debt had become the entry requirement. The infrastructure was built, and participation followed. The absence of debt became a disqualification from standard financial access, and because the system flagged debt-free adults as deficient, debt-free adults felt motivated to participate. The profitability behind this is not incidental. Since 2010, Americans have paid a cumulative $2.1 trillion in credit card interest alone. That figure exceeds the total outstanding balance of all U.S. student loan debt and all U.S. auto loan debt combined. Credit card operations at U.S. banks generate a return on assets of approximately 6.2%, 5 to 6 times the return of a typical bank loan portfolio. The normalization didn't produce the profitability as a side effect. The profitability is what the normalization was constructed to protect. Thomas Okafor is 43 years old. He's a senior civil engineer at an infrastructure consultancy in Charlotte, North Carolina. His wife, Vera, is a curriculum coordinator for the county school district. Combined household income, $230,000 a year. 2 children, 15 and 12. By every conventional metric, Thomas is doing well. His mortgage balance sits at $385,000 on a home currently valued at approximately $570,000. He and Vera have 2 car loans outstanding, a Honda Pilot and a Toyota Camry, combined balance around $24. Vera has $31,000 remaining on graduate student loans from her curriculum development degree. 2 years ago, they opened a home equity line of credit to replace the roof and HVAC system, $18. And total debt, approximately $458. Credit score, 774. Net worth on paper. Once debt is netted against assets and retirement accounts are included, Thomas would tell you accurately that every debt decision he made was individually defensible. He financed the cars because rates were favorable, and the financial advisor said maintaining liquidity was the smarter move over tying cash into depreciating assets. The HELOC rate was below any available personal loan. Vera's student loans are being repaid strategically because the interest rate sits below 5%. At that level, repayment is less efficient than investing the difference. He's done the math on each instrument. He can explain every number. He has. Multiple times. At dinner parties, when his parents-in-law ask why they don't just pay things off, Thomas walks through the logic. Pay patiently. He sounds financially sophisticated. He is financially sophisticated. He's applying the framework exactly as it was designed to be applied. One Saturday afternoon in March, Thomas does a calculation he has never done before. He's not calculating his debt-to-income ratio, which his advisor has reviewed and called healthy. He's calculating something else entirely. He's calculating how long he has been continuously in debt. The mortgage started 8 years ago. Car loans. He financed his first vehicle at 25, paid it off at 28, and within 4 months had financed another. Vera's student loans have been a constant across their marriage. The HELOC materialized as the second car loan balance was declining. His total debt position has never experienced a 12-month period where it declined meaningfully. The instruments change. The state of indebtedness doesn't. He has been a borrower, without interruption, for 18 years. This is not a crisis. He is not behind on payments. His credit score confirms a person managing debt correctly. His advisor reviews the portfolio twice a year and finds nothing alarming. Thomas runs one number he has never run before. If he freezes all non-mortgage borrowing today, no new auto loans, no HELOC draws, no additional student loan interest accrual, and redirects what's currently servicing those instruments toward a standard index portfolio, the projected change to his net position in 10 years is approximately $87,000. Not a dramatic number, but it's real. And it represents the compound cost of debt instruments that, by his own analysis, were never strictly necessary. He could have paid cash for the cars without materially affecting their liquidity position. The more precise question he is now sitting with is this: when was the option not to borrow presented to him? At every conversation with the car dealer's finance office, with the mortgage broker, with the financial advisor, the question on the table was which debt instrument to use, not whether to use one. The cash purchase option was not missing because no one knew about it. It was absent because the menu was built by people whose revenue depends on the transaction being executed. Thomas isn't angry. He arrived at this observation the same way he arrived at every other financial conclusion in his life, through a Saturday afternoon of clear-headed calculation. He sees the mechanism now. He sees that he was never trying to reach a debt-free life. He was trying to become a more competent borrower. And at some point he cannot identify the specific moment those two different projects became, in his framing, the same project. What happens now is unclear. The floor has been set. The commitments exist and are real. There's no clean exit from the structure he's built, but the observation he made this afternoon won't leave him either. That's where this case study ends, not with a resolution, with the recognition that a goal was defined by someone else, accepted as his own, and executed with considerable discipline over 18 consecutive years. Scale this out across the country. Total household debt across all categories: mortgage, auto, student loan, credit card, personal loan, stands at approximately $18.8 trillion. The average American household carries roughly $155,000 in combined obligations. Approximately 77% of American adults carry some form of debt. The 23% who are entirely debt-free skew heavily toward two narrow groups: the very young, who haven't yet built a credit history, and the older cohort, who've paid off mortgages taken on decades ago. The working, earning, professionally active adult population, the demographic that made every individually defensible decision Thomas made, is almost universally indebted. This is not the outcome of personal failure at scale. There are not 200 million undisciplined people. There is one infrastructure, and the infrastructure produces predictable, consistent outcomes. From 1951 to 2008, 57 years, American household debt grew in every quarter but 219 quarters of continuous expansion. Debt didn't grow because a generation forgot how to exercise restraint. Debt grew because the product design, the regulatory environment, the credit scoring system, and the cultural language were all configured to make debt expansion the expected, rewarded, and default behavior of a financially responsible adult. The normalization preceded the behavior. The behavior followed the normalization. Now look at the creditor side of that ledger. In 1978, the year of the Marquette ruling, total revolving consumer debt was $48 billion. By 1985, it was $131 billion. By 2008, it exceeded $992 billion. That is a 20-fold increase across a period in which real wages grew significantly more slowly. The gap between what households could earn and what the economy expected them to spend was bridged by credit. Consumer debt was not a byproduct of the economy. It was the mechanism that kept the economy running after wages stopped keeping pace with consumption expectations. Total banking industry net income in 2024 was $268 billion. Credit card operations, a subset of the consumer lending business, generate returns on assets approximately 5 to 6 times higher than a standard bank loan portfolio. These are not incidental profits from a product that would exist at the same scale regardless of cultural context. These profits depend on continuous debt expansion on populations that replace paid-off debt with new debt, generationally, reliably. The business model does not benefit from a population that successfully becomes debt-free. It benefits from a population that cycles through instruments while staying in debt. And the mechanism that ensures that cycling happens is the normalization. Each generation entering adult financial life is introduced to the same vocabulary: credit building, responsible borrowing, the taxonomy of good debt and bad debt. The onboarding process frames debt as a skill to be mastered rather than a state to be interrogated. The language is not transmitted by creditors directly. It's transmitted by parents, advisors, and educators who were themselves trained inside it and never had cause to question the frame. That's what durable normalization looks like. It doesn't need active maintenance. It reproduces through people who believe it. This episode is not ultimately about debt. It's about the mechanism by which an entire society came to measure financial responsibility, using a definition written by the institutions that profit from continued indebtedness. That is a specific, traceable thing. It was constructed over approximately 70 years through mortgage expansion, product design, a Supreme Court ruling that dismantled state interest rate caps, and cultural language that transformed what financial maturity was supposed to look like. The language works because it contains truth. Debt in specific conditions has genuine uses. The mortgage that builds equity in a rising market. The business loan that generates returns above its cost. The framework isn't false, it's incomplete. And the incompleteness is not accidental. The reframe isn't that debt is wrong. It's simpler than that. The definition of responsible you've been following was written by creditors. Consider what that definition rewards and what it penalizes. It rewards managing multiple debt instruments correctly. It rewards a long credit history. It rewards consistent engagement with the debt system across decades. What it penalizes actively is the absence of debt. No credit accounts means no score. No score means restricted access, higher rates on anything you do finance, exclusion from standard products. A person who chose never to borrow is not, by this definition, financially responsible. They are credit invisible, they are deficient. That inversion where refusing to borrow becomes a disqualification from full financial participation is the clearest evidence of what the definition was built to accomplish. There is a structural layer beneath all of this. Beginning in the 1970s, real wage growth in the United States began to stagnate. Purchasing power that households could no longer sustain through income had to come from somewhere. Consumer credit expansion filled that gap steadily, systemically, generationally. The growth of household debt from that period forward is not primarily a story of individual profligacy. It is the economic mechanism by which a consumption-dependent economy maintained growth after wages stopped rising with it. The normalization of debt was not a cultural accident. It was the cultural infrastructure for an economic arrangement that required consumers to spend more than they earned. The language of responsible debt management made that structural dependency legible as personal virtue. You weren't participating in an economic architecture that required your continued indebtedness to function. You were managing debt responsibly. You were sophisticated. Your score was 774. The prior question before the tactics, before good debt versus bad debt, before which rate to take and which instrument to choose is, whose definition of financial maturity am I optimizing for? Because if the answer is the institution that earns money when you borrow and continues earning money as long as you stay in debt, that is not a neutral standard. That is an incentive structure dressed as common sense. You were taught a curriculum. The curriculum served the institution that wrote it. Whether what you do with that observation is useful depends on where you are now and how fixed the floor has become. But the observation itself is worth making before the next conversation about which instrument to use. The most dangerous debt isn't on your credit card, it's the life you borrowed. When was the last time you were in a financial conversation where not borrowing at all was actually on the table? Think about who wasn't in that room. Normalization is the most powerful mechanism in the system. When something harmful becomes invisible because everyone is doing it, the trap is complete.